When the market went into a 30% free fall in early 2026, most of us thought Bitcoin would be the ultimate lifeline. But the reality was a painful wake-up call. Bitcoin evaporated 60% of its value against gold in just a few short months. Is it possible we've been misled by the very concept of digital gold? Think about it. For years, the narrative was simple. Bitcoin is the faster, better, and more modern version of gold, a hedge against inflation, a sanctuary in times of chaos. But as the geopolitical chessboard shifted and the global financial system began to creak under the weight of debt, the digital gold thesis didn't just stumble, it fractured. Take a look at the charts everyone is ignoring right now. While the media is busy shouting about the latest crypto bounce, the gold to Bitcoin ratio is telling a completely different story. It's a story of a silent, massive rotation. A story where the world's most sophisticated players are trading in their digital keys for physical bars. Why did the insurance fail exactly when we needed it most? Why did the narrative collapse just as the volatility spiked? Today, we aren't just looking at price action. We are going to deconstruct the behavioral psychology of the 2026 crash, the hidden hands of the central banks, and the sobering reality of what happens when the market is forced to choose between a 15-year-old code and 5,000 years of history. Let's dive in. To understand why Bitcoin failed this survival test, let's look directly at what happened on the gold BTC chart last December. For the better part of a decade, the digital gold narrative was invincible. It was the new paradigm. But as we crossed into 2026, the mask slipped. When the geopolitical tension hit its breaking point and the credit markets began to freeze, we saw something startling. Gold started to climb, slowly but steadily, carving out a new line in the sand. Meanwhile, Bitcoin, it didn't just drop, it behaved exactly like a high-beta tech stock on steroids. Look at this chart. When the S&P 500 slipped into correction territory, Bitcoin's correlation with the Nasdaq hit in a staggering 0.9. That's not a hedge, that's a mirror. If you were holding Bitcoin expecting it to zig while the world zagged, you weren't holding a sanctuary, you were holding a leveraged bet on global liquidity. The harsh reality is that Bitcoin currently functions as a high-leverage tech play. It thrives when money is cheap, when interest rates are low, and when the risk-on appetite is voracious. But 2026 is the year of risk-off. And in a risk-off environment, the market stops caring about scarcity in a digital ledger and starts caring about survival. This brings us to the core of the problem, the difference between volatility and intrinsic value. Bitcoin advocates always say, ignore the volatility, look at the long-term CAGR. And sure, the returns have been legendary, but volatility is not just a line on a screen, it's a psychological drain. When your net worth swings 15% in a single Tuesday, your brain doesn't see a store of value, it sees a threat. The amygdala, the part of your brain responsible for the fight-or-flight response, doesn't care about decentralization, it cares about security. And this is where the 5,000-year history of gold wins every single time. Let's talk about behavioral psychology for a moment. Why do people run to gold when the world feels like it's ending? It's not just because it's shiny, it's because gold has no counterparty risk. It doesn't require a functioning power grid. It doesn't require a high-speed internet connection or a specific software protocol to exist. It just is. In the heat of a panic, investors aren't looking for the asset that might go up 10x by next Christmas. They're looking for the asset that will definitely still be there in 10 years. Early 2026 gave us a clear choice. On one side, you had the New World asset that promised to revolutionize finance, but collapsed the moment the credit pipes got clogged. On the other, you had the Old World relic that everyone called Boomer Rock, which sat quietly and preserved purchasing power while everything else burned. But here is the twist that most people missed during the chaos. While retail investors were panic selling their Satoshis to cover margin calls on their stock portfolios, a different group of players was moving in the shadow. They weren't looking at the 15-minute candles, they were looking at the 100-year cycle. And if you think this was just a random market fluke, you're missing the bigger picture. Because while Bitcoin was struggling to find its floor, the biggest whales in the global ocean, the ones who actually print the money we use, were making a massive, coordinated move. And no, they weren't buying the dip on Bitcoin. To see what they were actually doing, we have to look past the retail noise and into the vaults of the central banks. Because they are playing a game that makes the gold versus BTC debate look like child's play. If you want to know where the real money is moving, stop looking at Twitter threads and start looking at the vaults of the BRICS Plus nations. Because while retail investors were arguing over the halving or the latest ETF approval, the largest whales on the planet, the central banks, were executing the biggest gold grab in modern history. According to the latest data from the World Gold Council, central bank net buying hasn't just increased, it has shattered records. We are talking about thousands of tons being moved off the open market and into sovereign deep storage. China, India, Turkey, and a growing list of Eastern European nations aren't just diversifying, they are building a financial fortress. This brings us to a question the crypto bros hate to answer. If Bitcoin is so superior, why aren't central banks buying it? It's not because they are old or don't understand the tech, it's much more clinical than that. It comes down to sovereignty and legal recourse. Central banks operate in a world of realpolitik. They need assets that represent a Tier 1 reserve, assets with no counterparty risk that can be used to settle international trade even if the internet goes dark or a rival superpower cuts your access to the SWIFT system. Bitcoin, for all its brilliance, is a stateless asset. For a central bank, that's not a feature, it's a fatal flaw. They cannot control the protocol, they cannot reverse a fraudulent sovereign transaction, and they cannot use it to peg a national currency without surrendering their monetary policy to an algorithm they didn't write. But the biggest reason? Deep liquidity. Think about the scale we're talking about. When a nation like China wants to move $50 billion out of U.S. treasuries, they need a market that can absorb that move without exploding. This is where the fragility of the crypto markets is exposed. Even in 2026, the entire Bitcoin market cap is dwarfed by the global gold market. If a major central bank tried to move $20 billion into Bitcoin in a single week, the price would moon to $1 million and then collapse the moment they tried to use that liquidity to pay for oil or grain. Gold, on the other hand, is the ultimate deep ocean. It can absorb a $100 billion wave with barely a ripple. That stability is what makes it a reserve asset. Bitcoin's volatility makes it a speculative tool. Now here is the twist that changes everything. Most people think gold is rising because of inflation or interest rates. They're wrong. Gold is rising because we are witnessing the weaponization of the US dollar. When the West froze Russia's foreign reserves in 2022, every central bank in the world realized that their money in the bank wasn't actually theirs. It was a permission-based entry in a ledger controlled by Washington. The current gold surge isn't being driven by your neighbor buying a few coins for his retirement. It is being driven by sovereign states preparing for a systematic reset of the fiat currency order. They are moving back to a hard asset standard because they no longer trust the paper standard. Gold is the only asset that doesn't require a "trust me" from a foreign government. It is the ultimate line in the sand. So while Bitcoin struggles with the fragility of digital exchanges and regulatory crackdowns, gold is being hoarded by the people who actually run the world. They aren't betting on a tech revolution, they are betting against the survival of the current debt-based monetary system. But even if you realize the big players are choosing gold, you're still faced with a massive problem. In a world of high-frequency trading and algorithmic manipulation, how do you actually time your entry into an asset that everyone is suddenly trying to buy? Because as we move into the final act of this cycle, a phenomenon is about to occur that will catch both gold bugs and crypto believers completely off guard. It's called the liquidity paradox, and if you don't understand it, you're going to get wiped out, regardless of which side you're on. But here is the sobering reality that catches most investors off guard. When the real panic starts, everything, and I mean everything, goes down. This is what we call the liquidity paradox. Think back to the chaos of early 2026 or the 2008 financial crisis. When the market collapses and margin calls start screaming, big institutions don't sell what they want to sell. They sell what they can sell. Because gold is one of the most liquid assets on the planet, it often gets sold off first to cover losses in tech stocks or failing private credit loans. If you see gold drop 10 or 15% during a market wipeout, don't panic.
History tells us this isn't a sign of weakness. It's a sign of a liquidity vacuum. Look at the fractals from 1973 and 2008. In both cases, gold took a temporary hit alongside the S&P 500. But while stocks took years to recover their real purchasing power, gold was the first out of the gate. It bottomed early, turned around, and surged to new all-time highs while the rest of the financial world was still picking up the pieces. Gold is like a beach ball being held underwater. The more the market tries to push it down to raise cash, the harder it snaps back to the surface once the pressure eases. So where does this leave Bitcoin? We have to be intellectually honest. We aren't hating on Bitcoin. We are placing it in its proper category. If gold is your insurance policy, Bitcoin is your venture capital. In the 2024-2025 boom, Bitcoin was the king of gains because liquidity was flowing. But in the 2026 to 2030 era, an era defined by geopolitical uncertainty and higher real rates, the role of Bitcoin in your portfolio must be redefined. This is where the barbell strategy comes in. On one end of the barbell, you have your survival assets. This is your physical gold. This is your protection against a system reset. It's heavy, it's boring, and it doesn't have a 24/7 Telegram hype train. But it works when nothing else does. On the other end, you have your speculative growth. This is Bitcoin. It's your bet on the future of digital finance. It has the potential for 10x returns, but it also carries the risk of a 70% drawdown when the global risk-off switch is flipped. The mistake most investors made in 2025 was treating the entire barbell like it was made of Bitcoin. They mistook a high beta asset for a defensive one. As we move toward the end of the decade, the winners will be those who rebalance. They will treat gold as the core of their wealth preservation and Bitcoin as a tactical wealth generation tool, but they will never, ever confuse the two again. The resilience of gold in 2025, even as stocks stumbled and Bitcoin topped out against the metals, was a warning shot. It showed us that people are losing faith in harder digital assets and moving back to the hardest physical ones. We are entering a period where the TINA trap, there is no alternative, is being replaced by a much more dangerous reality. There is an alternative, but it's not a new coin or a new AI stock. It's the oldest money in existence. As we look toward the next few years, the question isn't whether Bitcoin will survive. It probably will. The question is whether your portfolio can survive the volatility required to find out. If you are 100% in risk assets, you aren't an investor. You're a passenger on a ship with no lifeboats. Gold is that lifeboat. It might not be the fastest way to travel when the seas are calm, but when the storm hits, it's the only thing that matters. So how do we move forward? How do we synthesize this data into a plan that actually protects your family's future? It starts with a fundamental shift in perspective. We need to stop asking, how do I make more dollars? And start asking, how do I make sure my wealth exists outside of a failing dollar system? The conclusions we've reached today aren't just about price targets for 2026. They are about the structural endgame of a 50-year experiment in fiat currency. And as we wrap this up, I want to leave you with one final thought that might just change the way you look at your bank account forever. The battle between gold and Bitcoin isn't just about price, it's about identity. We've been living through a decade where the lines were blurred, but 2026 has brought us back to a sobering reality. Gold is the insurance for the system itself. Bitcoin is a high-stakes bet on the future of financial technology. Both have their place, but confusing the two when the storm hits is a mistake your portfolio may not survive. The market isn't wrong for selling off Bitcoin during a liquidity crunch, and it's not old-fashioned for rewarding gold. The market is simply telling us the truth. We were the ones who were wrong. We were the ones who assigned Bitcoin a title, digital gold, that it simply wasn't ready to carry. As we navigate the rest of this decade, remember, the goal isn't just to be right, it's to stay in the game. In an era of weaponized currencies and systemic debt, being right about a tech play won't matter if you don't have the insurance to survive the reset. So, I have to ask you, after seeing the data from this recent cycle, how has your strategy changed? What percentage of your survival fund is in physical gold versus Bitcoin? Are you rebalancing your barbell, or are you doubling down on the digital ledger? Leave your numbers in the comments below. Let's have a real discussion about what a survival ratio actually looks like in 2026. The era of easy money is over. The era of real value is just beginning. Make sure you're on the right side of history. Thanks for watching.